CPI and inflation don't matter anymore. What's up, guys? I'm nobody special. And that might seem like a bit of a hot take, and maybe it was a little bit excessive. But my point is the most important thing going on in markets right now is no longer inflation. In 2022, you bet that was the case. Just like in 2021, the big story was this monster bull market. And in 2020, it was all about the money printing. But 2023, inflation is no longer the big story. And everybody right now is watching the markets, hoping for a lower CPI print tomorrow so the stock market can go crazy. But that's the wrong thing to be worried about. So let me ask you a question. If Americans already can't afford the price increases that we saw in 2022, then does it really matter if prices are going up by 6% or by 7% if they already can't afford it? No, it doesn't. The real thing we need to worry about right now is layoffs and wage increases. Those are the two issues that will determine the direction that markets and the economy as a whole heads into 2023. Now, what you're looking at here is one of the most important charts in the market right now. This is America's credit card bill, all credit cards and revolving plans in the U.S., and it's nearly $1 trillion. This is America's failure to adapt to the cost of living increases of 2021 and 2022. Most Americans did not make enough adjustments to their spending, or their wages didn't go up enough to compensate for inflation, and so Americans put life on the credit card. That is a finite resource. You can't do this forever. Sooner or later, the banks are going to cut us off. Look for clues to that on Friday when banks start to report their earnings. Just how much of a hit to the earnings are the major banks going to take for credit loss provisions as they set aside money to prepare for people not paying off their credit cards? If Americans don't get a big enough raise this year, or if this wave of layoffs that we see starting right now continues and gains steam, then this chart is going to get bigger and it's going to come back to haunt a lot of people. And you better pay attention to this chart too, because this is the interest rate Americans are paying on that debt. So not only is America's credit card balance getting bigger and approaching $1 trillion, but the interest rate over the last few years has gone from about 14 or 15%. Now it's pushing 20%. So the cost of carrying that debt is also going up. And you can see him talking about that today on CNBC. Americans lean more on credit cards as expenses stay high. 46% of cardholders now carry debt from month to month. That's up from 39% a year ago. So again, I have to ask you, does it really matter how much prices are increasing right now if people already can't afford it? If something's already too expensive for you to buy and it gets even more expensive, well, you still can't afford to buy it. So that company's earnings are going to go down. Debt is going to get defaulted on. Multiples will contract in the stock market, and the economy will slip into a deep and severe recession. The only thing that can prevent that at this point is wage increases and the avoidance of layoffs. And right now, this guy is doing everything he can in his power to make sure those wage increases don't happen and to cause more layoffs. He is deliberately causing higher unemployment. He's said it explicitly over and over again. And you can see it in the housing market too. Look at home sales in the U.S. Why are home sales collapsing right now? Because nobody can afford homes. The interest rates on the mortgages and the prices of the homes, they're just too high. Nobody can afford it. So whether inflation is 6% tomorrow or 7% tomorrow, the end of the day, people can't afford homes. That hasn't changed. But take a look at this chart and keep in mind that home prices still haven't moved. The number of sales is down, but the prices haven't budged because the buyers are leaving the market because they can't afford the homes, but the sellers are also leaving the market because if they sell their house they're living in right now, they can't afford to buy anything else. But what happens if people get laid off? When people lose their jobs, they sell their house whether they want to or not because they have to. That means if this wave of layoffs continues, we're going to see a sudden surge in new supply hitting the housing market. And with so few sales happening right now, this illiquid housing market, new supply could cause a very rapid contraction in home prices. That, coupled with defaults on mortgages from people losing their jobs, means the banks are going to be taking it on the chin with losses for home loans. So once again, it's not really about whether the home prices are going up 6% or 7% or whether owner's equivalent rent is 0.4 or 0.5. The question is how many people are going to be forced to sell their home into this illiquid housing market. It's all about the jobs right now. Now, realistically, the CPI reading tomorrow, it will be an important statistic. It probably will move markets one way or another. Everybody's going to be watching it. I'll be live streaming it starting at 8:15 a.m. Eastern time because I think it's an important data point. But right now, it's not the most important data point, not like it was in 22. In 2023, it's all going to be about the jobs and about the wages. If the job situation deteriorates the way Jerome Powell is hoping it does, and if the wages don't increase to keep pace with inflation, then the earnings of just about every company in the S&P 500 are going to collapse. Sales of virtually everything will go down because nobody can afford the stuff. And with that mounting pile of credit card debt and rising interest rates, we're going to start seeing defaults on debt very soon now, and the banks are going to be talking an awful lot about that starting on Friday when they release their earnings. Till next time, live small and dream big.